Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Delta stock so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 30 billion market cap. They're trading at $46 a share, and they have 643 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. 2020 was a rough year for this company and all airlines due to COVID, so they had a big negative in free cash flow. A small positive in 2021, a small negative in 2022. But things are looking up, over 800 million in the trailing 12 months. Net income is a profit or loss on the income statement. It's revenue minus expenses. Big negative in 2020, and then it's improved a lot. 300 million in 2021, 1.3 billion, and it's currently 3 billion in the trailing 12 months. Revenue is a sales for the company, and that's grown 200% since 2020, from 17 billion to 56 billion. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 46 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $40 billion. We divide that by 640 million shares. And we get a calculated stock price of $63. They're trading at $46, so they're trading at a 26% discount. It's a buy according to the model. Airlines are doing really well now. Sales are through the roof, so they look like good investments at this point. There are 15 companies in the same industry as Delta, and if Delta has a number in red, they're worse than the median. If they have a number in blue, they're better. They spend a ton in CapEx, over $6 billion. The only company that spends more is United. Most of their CapEx spend is the purchase of aircraft. They have a really high debt to equity ratio. For every dollar of equity, they have $3.40 of debt. They're still generating negative free cash flow, but I think that's about to change. They're the largest company on this list in terms of market cap. All their price multiples are worse than the median, and we can't look at their price to free cash flow since they have negative free cash flow. They do generate lots of revenue, but they rank third on this list. The most is American Airlines, the second most is United. And their 5-year annual revenue growth rate is 5%, which is equal to the median average. Look at Spirit at 15%, that's pretty impressive. Allegiant is also double digits at 10%. Mace is struggling in this category, they're negative 4%. Just the other day, they released their second quarter earnings. They did beat analyst forecast on revenue and earnings. This is the 4th straight quarter they beat the revenue forecast. Let's go through their second quarter earnings slides. And this is for the quarter ending June 30th, 2023. They're doing so well, they're going to raise their full year EPS outlook to $6 to $7, which should give them free cash flow of $3 billion for the year. This quarter, record operating revenue $15.6 billion, record operating income $2.5 billion, with an operating margin of 16%. That's a really good margin for an airline. Pre-tax income of $2.3 billion, EPS of $2.84, operating cash flow of $2.6 billion, so they're generating a good amount of cash flow. Their free cash flow for the first quarter is $1.1 billion. Their forecast for next quarter, the third quarter of 2023, is for revenue growth of 11 to 14%, full year revenue growth of 17 to 20%, operating margins next quarter in the mid-teens, for the full year above 12%, and EPS next quarter of $2.20 to $2.50, full year $6 to $7. So this could be a great time to get in on Delta. Their TRASM is up 1%. Compared to the same time last year. That's total revenue per available seat mile. That's a common term when you look at airlines. They had record international performance, revenue up 61% compared to the prior year. That's driven by strong US consumer demand, and they benefited a lot from the reopening of Japan. Domestic demand still remains strong. Domestic passenger revenue up 8%. Corporate revenue grew, and 93% of companies expect their travel will increase or stay the same next quarter. Most of an airline's profits are from first and business class, which did grow, outpacing main cabin revenue. Premium revenue increased 25%. Loyalty revenue improved 20%. And the reason airlines are doing okay now is because gas prices have come down quite a bit. They were really high at one point. Operating expenses of $13 billion, non-fuel expenses $9 billion. Non-fuel CASM was 2.4% higher. That's cost per available seat mile. Fuel expense of $2.5 billion, down 24%. Fuel efficiency was 14.4, a 1% improvement from last year. They added $2.9 billion of free cash flow in the first half of the year. And they're accelerating debt payment with a goal of retiring $4 billion of debt this year. That's the problem with these airlines. Mainly United, Delta, American, they're saddled with debt. JetBlue and Southwest are the best airlines. They're really well run. They use the more efficient point-to-point system, not the hub and spoke. We are on track to reduce leverage to 3x. If they get it down to 1x, that would be great. But you got to start somewhere, as long as you're moving in the right direction. Their net debt is $20 billion. Net debt is debt minus cash, a reduction of $2.5 billion from 2022. Their payments on debt and finance lease obligations were $1.8 billion this quarter. That includes $800 million of maturities and the early repayment of $1 billion of debt instruments with an average interest rate of 7%. That's a high interest rate, so it's good they got rid of that. Their weighted average interest rate is 4.6%. Most of that is fixed rate debt. 88% of that debt is fixed rate. Their liquidity is $8.8 billion. That's cash available. And they footnote it right here. That includes cash and cash equivalents, short-term investments, and undrawn revolving credit facilities. Delta earned the #1 spot on the Points Guys list of the best U.S. airlines for the 5th year in a row. They score high in reliability, customer service, network, and loyalty program. They had their largest summer schedule ever, 650 weekly flights to 32 destinations, and a 20% increase in seat capacity versus 2022 summer. They're enhancing their service with Latin America. They're making deals with Israeli airlines. They took delivery of 18 aircraft this year, and that includes 12 this quarter, including the A321neo, A220-300, and Airbus 330-900. And there's an option to purchase 12 additional Airbus 220s, and added 1 Airbus 330 to the order book. They were named one of the best employers for diversity by Forbes. They welcomed over 3 million new Sky Miles members in the quarter, marking the 2nd consecutive record quarter. Operating income of $2.5 billion, up from $1.5 billion, which is nearly a $1 billion increase, or 64%. And their margins are up a lot from 11% to 16%. Net income more than doubled from $735 million to $1.8 billion. EPS up from $1.15 to $2.84. Revenue went from $13.8 billion to $15.6 billion. Revenue per available seat mile is down from $23.47 to $22.58. Expenses are getting higher from $12.3 billion to $13 billion. Expenses are up 6%, but revenue is up more, 13%. That means their margins are improving. Fuel expense is down from $3.2 billion to $2.5 billion, down 22%. And the average fuel price went from $3.74 to $2.52. That's their biggest expense by far, fuel. Operating cash flow is only up a little from $2.5 billion to $2.6 billion. They're spending more in CapEx, $958 million to $1.5 billion. 52% more CapEx spend. Their debt is a lot lower, $24.8 billion to $20.2 billion, down 19%. Let's look at their income statement. Revenue of $15.6 billion. Here's a breakdown of the revenue. $13.2 billion from passengers. That's people paying for their flights, their tickets. $172 million from cargo, people paying baggage fees. And then other. Cargo revenue is down 37% from last year. Other revenue is down 15% from last year. But total revenue is up 13% from last year. That's because passenger revenue is up 21%. For the trailing 6 months, revenue of $28 billion, up from $23 billion, up $5 billion or 22%. And that's mainly from ticket prices that are up 32%. Let's look at their expenses. Salary is up a lot, 25%. It's up $737 million. But fuel is down almost the same amount. It's down $707 million, 22%. Delta's other revenue includes the company's oil refinery business and other ancillary businesses. That includes aircraft maintenance services and the company's vacation wholesale operations. Also the company's loyalty program. One of their subsidiaries is a Trainer refinery. This is an oil refining facility in Trainer, Delaware County, Pennsylvania. Remember when we talked about upstream, midstream, and downstream? Refining is a downstream part. That's the last part of the oil and production process before it gets to the end user. And who's the end user? Well, in this case, it's probably airlines. They're making jet fuel. Some companies are refiners for regular gasoline for cars. It talks about it right here. I didn't even see. In addition to jet fuel, the facility also produces gasoline, diesel, and home heating oil. Let's go back to the income statement. So total expenses of $13 billion, up from $12.3 billion, up 6%. Operating income $2.5 billion, up from $1.5 billion, up 64%. They only paid $200 million of interest on their debt, lower than last year of $269 million, down 25%. Their income before taxes $2.3 billion, compared to $1 billion from last year, up $1.3 billion. They paid $500 million in taxes. That's up 64% from last year. Their net income is $1.8 billion, up from $700 million, which is an increase of $1 billion. Their EPS is $2.86, up from $1.15. They do have more shares outstanding, 639 million this year. Last year was 638 million, so they added 1 million shares. Here's a breakdown of their passenger revenue, the $13.2 billion. 6.7 billion is from regular tickets in the main cabin. That's up 18%. Premium tickets, first and business class, 5.1 billion, up 25%. Loyalty travel awards, 900 million, up 21%. Travel related services, $500 million, up 7%. So passenger revenue of 13 billion, up 21%. Revenue in their refinery business is down. It's 965 million. It was 1.5 billion. I think that's because gas prices are a lot lower now. But revenue is up in their loyalty program, up 19%, up in ancillary businesses, up 4%, and miscellaneous is up 11%. So other revenue is down 15% overall. It's 2.2 billion, it was 2.6 billion. Here's another breakdown of their revenue. Of the 15.6 billion, 9 billion is domestic US, 2.8 billion Atlantic, Latin America 900 million, Pacific 530 million. Passenger revenue 13.2 billion, cargo 170 million, other 2.2 billion, so total is 15.6 billion. Let's take a look at the company on Simply Wall Street. Last price $46.49, 30 billion market cap. It's up a lot, 55% in the past year. Delta provides scheduled air transportation for passengers and cargo in the US and internationally. The company operates through two segments, airline and refinery. We talked about that refinery earlier. Its domestic network centered on core hubs in Atlanta, Minneapolis, St. Paul, Detroit, and Salt Lake City, as well as coastal hub positions in Boston, LA, New York, and Seattle. They also have international hubs in Amsterdam, Mexico City, London, Paris, and Seoul. The company sells its tickets through various distribution channels, including Delta.com and the Fly Delta app, online travel agencies, traditional brick and mortar, and other agencies. It also provides aircraft maintenance and engineering support, repair and overhaul services, and vacation packages to third-party consumers, as well as aircraft charters and management and programs. The company operates through a fleet of 1,250 aircraft. Aircraft is automatically plural, so they shouldn't have an S here. Aircraft is not a word. The word aircraft refers to one or multiple planes. Delta was founded in 1924 and is based in Atlanta, Georgia. The risk they list is high level of debt. The stock price back in 2007 was $19. In 2009 was its low point, a little over $4. Then over the next year or two it went up, and then over the next year or two it came down. It had a really nice run up from 2012 to 2015. It got into the low 50s in 2015. It peaked in July 2019 at $62. And then it really crashed during COVID. It fell to about $20. Then it ran up to close to 50. Then it came down to below 30. But now it's on a bull run, getting close to 50 again. In the past 5 years, the stock is down 11%. Better than its industry, down 26%. But the market is up 52% in the past 5 years. In the past 3 years, the stock is doing great, up 72%. The past year, up 55%. And doing well in the past 90 days, up 34%. Much better than its industry in the market. Not surprisingly, this stock is really undervalued according to Simply Wall Street. Their price is $122. They say it's 62% undervalued. 19 analysts priced this stock at $60. They say it's 29% undervalued. Their trailing 12-month revenue in 2012 was $36 billion. and it slowly increased over the next 7 or 8 years. It hit 47 billion. Then in 2020, it came down to a really low point, under 13 billion. But now it's at its highest point ever, almost 56 billion. Things are going really well. And the forecast is for the revenue to hit 60 billion by 2025. In 2013, they had negative equity, which means their liabilities are higher than their assets. That did improve a lot in 2014 and 15. Their equity was higher than their debt. Then when COVID hit, their debt went through the roof. It got to its highest point ever, 35 billion, and their equity came down to 3.4 billion. Since 2020, their debt has been declining a lot. It's at 20 billion, and their equity has come up to 8 billion, so their debt to equity is 240%, which is still a bit leveraged, but a lot better than what it was during COVID, over 1,000% debt to equity ratio. That means for every dollar of equity, they had $10 of debt. Their dividend is under 1%. The industry average is 2.6%. Their payout ratio is only 2%. They pay 40 cents of dividend per share. Their EPS is 466. 40 cents over 466 is about 11%. So I'm not sure how Simply Wall Street gets 2%. The light blue line is their dividend payout. And you can see they raised it each year up to 2020. In January 2020, they were paying $1.61 per share in dividends, a yield of 2.7%. The bluish line is their yield. Then they cut their dividend entirely, and they did bring their dividend back in 2023. The forecast is for the yield to get up to 1.6% by 2025. The CEO's salary is $950,000, total compensation $9.6 million. His tenure as CEO is 7.2 years. In the past 12 months, there's been insider buying and selling. There are more sells than buys. All the people sold in the 30s. If they would have waited, they could have sold at a higher price. 70% of the company is held by institutions, 30% by the general public. Vanguard is the biggest shareholder at 11.5%, 73 million shares. Their employee count in 2012 was 77,000. Right before COVID, it was 91,000. Then they got rid of a lot of people during COVID, down to 74,000. Now they're at their highest point in terms of employees, 95,000. You can see the stock trades in a lot of places: New York Stock Exchange, Deutsche Börse, Xetra, Mexican Bolsa, Swiss, London Stock Exchange, Wiener Börse, Lima Bolsa, and Sao Paulo Bolsa. So that's the end of the video. Let me know what you think. Leave a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.